Hello, everyone. Today on the Final Bar, I have Todd Sohn from Strategas joining us. We'll talk about some of the charts that he is focused on to try to navigate this market environment. It's Wednesday, July 20th, sort of a bounce early on in the day, but stabilizing through the course of the day. S&P with a decent upside follow through up to 39.60. The question, as always, is how do you differentiate a bear market rally from the bottom, the beginning of something a little more meaningful, a little more significant? It's all about the reversal in trend, ladies and gentlemen. This is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us here on a Wednesday afternoon as we break down the activity in the markets using the power of technical analysis. The technical toolkit is designed to help you limit your emotional inputs in your decisions and maximize more of the emotionless component to your decision. I was talking with our friends at the CMT Association, David Lundgren, Tyler Wood earlier today. I was doing an interview for their podcast, Fill the Gap, and we were talking about the value of technical analysis. One of the things that we focused in on the conversation was its ability to help you manage risk by recognizing when the world has changed. As we've talked about on the show, I think your goal as an investor should be threefold: identifying trends, following those trends, and identifying or anticipating when those trends might be exhausted. This is arguably that third component where we're starting to get signals of a reversal. You're starting to see banks like Goldman Sachs and others break above short-term highs. You're starting to see Netflix break out of a congestion zone, getting above 200. Stocks like Apple, bit of a positive rotation. Is that enough to make this into something more significant to the upside? That's the real question here. What we're going to do is look at it on different timeframes, talk about the short-term strength, but also respect the longer-term trends, because I think that's the game for a lot of investors. I want to share with you the schedule coming up. Excited to have Todd Sohn from Strategas joining us back on the show. He always does a great job sharing some of the charts that he's sharing with his institutional audience, which is always really valuable. Next couple sessions, Thursday and Friday, we're actually going to be out of town, and we have two special programs set up for you. Tomorrow, we'll be digging into trend line analysis and share some best practices that I found over a career of trying to use trend lines. On Friday, we'll talk about market history. Now more than ever, need to understand how this current market, while unique, is very similar to other previous bear market cycles. And we'll look at some of the evidence together. Next week, on Tuesday, the 26th, we have Bob Lang. And then on Wednesday, the 27th, Dale Pinkert from Forex Analytics. Let's continue on today's show, talk about these markets in our market recap. And let's get to the charts. The S&P 500 up about 0.6%, right around 39.60. A decent follow-through day from yesterday. Anytime you have a big move, like we saw yesterday, like we saw the day before for stocks, it's all about the follow through. It's all about if you see additional validation of that direction. You're seeing a nice bounce on a lot of names, particularly sort of the FANG sector areas like communication services, consumer discretionary, which are the two top performing sectors today. The tech heavy Nasdaq up about 1.6%. Far outpacing the Dow, which was up just a little bit over unchanged today. The VIX is now below 24. So you've seen a continued lessening of volatility while still elevated relative to previous years, taking 2022 as a series of observations, now getting more to the lower end of the range that we've seen for this calendar year. Looking at the fixed income markets, a bit of a mixed results for interest rates, with 30-year yields, a long bond yield coming off a bit, 10-year yield increasing a bit, around 304. The dollar index up about 0.25%. Not much change there, to be honest with you. Further weakness in gold and silver, with the GLD, the gold ETF, down about 0.9%, really accelerating lower into the close. Looking at charts of Newmont Mining, just dismal charts. When you think about other ones that have stopped going down, right? Sort of the average stock accelerated down to a new low in June, now has sort of been chopping sideways. Newmont Mining, ignoring that last part, just continuing to pound to the downside, testing long-term support, which is interesting, but not showing any signs of abating that downtrend that we've seen for quite some time. Cryptocurrency is mixed right now, and Bitcoin earlier in the day had a nice sort of move to the upside to around just above 24,000, pulling off just a little bit, but still well above where we've seen the last couple of days. We've seen a nice recovery from Bitcoin, nice recovery for Ethereum and some of the other liquid coins that we track on StockCharts. And that's an interesting space to watch because it's an interesting proxy for speculation, right? If you think of bets on Bitcoin and Ether, while there's certainly some long-term money invested there, a lot of it is speculative pressures, depending on where people are willing to take risks, whether they're willing to take additional risk in the portfolio. So rally in Bitcoin, I would argue at this point, probably a good sign for other risk assets like equities in particular. Looking at a daily chart of the S&P, what's changed from yesterday? Well, yesterday on the show, we talked about the close above the 50-day moving average. We'll zoom in just a little bit here, like at the last 6 months, so we can pay attention to the short-term dynamics here. So we closed above the 50-day on yesterday's session. What we talked about on yesterday's show is all about the next day. Do we get that follow-through? Do we get validation that this just wasn't a one-time thing, but had some staying power? The fact that we're getting a further upward move today seems to further validate that breakout. So at this point, what do? I would argue that short-term, sort of bullish move, if you consider this a consolidation pattern that's now resolved to the upside, it's all about remaining above the previous resistance. Resistance becomes support, and sort of this 39.20 range, which is the price resistance that we saw from late June, early July, and then the 50-day moving average. As long as we remain above those, overall, this new tactical bull trend most likely continuing. If we fail to hold those, though, we're back to confirming the bear market phase that we've been in for some time now. I think it's important right now to think about the different timeframes at work in the market. Our market trend model that we refer to pretty regularly on Friday's show, usually still showing weak long-term and weak medium-term trends, right? Using the S&P weekly data. So even though we've had a nice bounce this week so far, overall, the long-term trends, I would argue, still most likely down. We see this sort of downward trend of lower highs that, arguably we're sort of in the midst of this next lower high after the one from last June. So I would argue we really need to get above, say, 4,200, which would take us above the June high. That would take us above that Fibonacci resistance level. That was the last time the market really stalled out here. You get that kind of follow through, and this all of a sudden becomes a pretty encouraging chart with enough demand to really rotate and give what I would call a change of character from downtrend to uptrend. It's always important to differentiate the short-term rallies, the short-term bounces with other timeframes as well. I wanted to talk briefly about breadth because one particular area that I'd like to focus on is the percent of stocks above their key moving averages. It's worth noting as of, I think this is as of yesterday's close. Actually, it's as of today because this is updating during the day, right at about 50%. So about a month ago, it was down to single digits of S&P members above their 50-day moving average. What's happened in the last 4 to 5 weeks is we've seen about 45% of the S&P, almost half, go from being below their 50-day moving average to above their 50-day moving average. A lot of that's happened in the last couple sessions. So this rally that we've seen, it's actually pretty significant. In general, I had this big horizontal pink line on both of these indicators tracking the 50% level. This indicator is below 50%, tells you most stocks are in a downtrend using the 50-day as a proxy for that trend gauge. If it's above 50%, it means over half of the S&P are in a bullish trend. We're sort of right at that point. Now, what's interesting is we got right to this point in early June. This is when this rally stalled out, right? We got right to 50%. All of a sudden, it felt like, well, you might be retesting the previous highs. Do we get back to 4,600? That was it. We spent another week or so sort of chopping around, and then it resolved to the downside. That's the risks to this sort of market. Bear market rallies, while sudden and severe and seductive, and certainly attractive in the short term, often stall out very quickly, and then you roll right out to retest to the new low. So given the fact that we overall, I think, remain in this bear market phase, tells me to stay vigilant and be focusing on the trend characteristics. Make sure that I respect the different timeframes at work. Also worth noting, the bullish percent index for the S&P 500 just got above 50% today as well. Now, what that does is it's looking at 500 different point and figure charts, and it's saying for each one of those members of the S&P, is their point and figure chart most recently giving a buy signal or a sell signal. The fact that it gets above 50% this week tells you that now over half of the S&P members have generated a buy signal most recently. And what that tells you is that there's starting to be a broad advance. It's not just a small number of names that are bouncing. It's now a broader number of names. This is where the financials and other sectors, some of the FANG sectors, have really started to see some rotations to the upside. So there's no denying that this is a meaningful bounce. The question is, does it have staying power? This last rally, by the way, in late May, early June, this indicator stalled out around 60 to 65, is right around 63. And that might be what I would look for here to see how closely we line up with that previous, most recent tactical rally in the markets. Just to finish off our market recap, check in on the sectors. It was all FANG and then everything else: communication services, consumer discretionary, technology, all up over 1.5%. 4 of the S&P sectors were down today, and it was basically the defensive parts of the market. Utilities down 1.33%, healthcare down, consumer staples, and real estate. Healthcare is an interesting one. A little later in today's show, we're going to do a segment, the bottom line, where we focus on earnings, and we'll talk about charts like J&J, like Abbott, others in the healthcare sectors potentially started to rotate a little bit after a decent little bout of outperformance. Let's take a quick commercial break. We'll be back with Todd Sohn from Strategas. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down these markets using the power of stock charts. The technical analysis toolkit has so much in built in to help you make sense of markets during uncertain times, help you understand the trends that are evolving. A couple quick announcements before we get to today's guest, Todd Sohn from Strategas. First off, we welcome your questions. We had a great mailbag segment yesterday. We answered a number of questions on market dynamics, on technical indicators. We'll do another one next week, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air in our next mailbag segment. Also, go to StockChartsTV.com. That's our on-demand platform. All of our great content. We produce about 2 to 3 hours of new content every trading day, all technically oriented, trying to help you make sense of these markets. A great suite of expert commentators at StockCharts and fantastic guests like Todd Sohn and others. You get a great overview of technical perspective at all times at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Todd Sohn. Todd's a technical strategist at Strategas Securities, joining us from New York. Todd, it's great to see you again. Thanks for coming back on the show.
Hey, Dave. Always great to chat with you, and thanks for having me on.
So a fascinating week. We've certainly seen some short-term strength, a lot of bounce in a lot of key names. What is your toolkit telling you about this current sort of short-term up move in the markets?
I think you really hit it spot on earlier with that time frame matters here, right? The longer-term trend is still well down. We're in a bear market, across most asset classes, with the exception of commodities. But if you're a short-term player, there's some room to run. I'll throw a stat out at you. The average bear market rally is about 15% over 30 days for the S&P 500. And if you extend that to the Nasdaq 100, it's about 30% over 35 trading days. So if you're playing short term, I think there's some room to run here. And that actually reflects pretty well in the first chart we're showing, which yesterday we had a 90% up there. It was the first time in over a year we've seen that. So really good breadth yesterday. And that's a change from what we've seen over these prior rally attempts in the last 7 months. Now, it's a step in the right direction, but you really want to see more of them, right? More unmistakable breadth surges. And that you'll see that confirmed by the 10-day average on the lower panel there. That's still short. So a move in the right direction. We like it. It's good for short-term players, but there's still more work to do. And it's a day-to-day assessment for us in our work.
So maybe a little more to prove for potential upside in stocks. Your second chart, Todd, is looking at the fixed income markets. We've seen flows into bond funds, apparently, right?
Yeah. So I think what's a catalyst to continue to rally, whether it's another 10% or so, we'll see, is the sentiment backdrop. We always like to look at flows to gauge where investors are moving their money. And, part of this might be due to tax loss harvesting, moving into bond ETFs and whatnot, but we're of the opinion that this surge in bond flows, whether it's short duration or long duration, is reflective of very anxious equity market, and you typically see it surge during corrections. But right now, it's overwhelming. And you pair that off with speculator positioning in the futures market, which is actually net short right now to a pretty aggressive level. That's a nice cocktail for pretty pessimistic sentiment, at least in the near term. Maybe it's not apocalyptic like you've seen at other lows, but enough to continue to see the market rally in the near term.
It's so interesting, Todd, as you're showing these two charts. I mean, I'm thinking about the overall, evolution of the market in 2022. 2022 so far has been about, in many ways, energy and everything else, right? Sort of the growth sectors really struggling. Energy, some of the cyclicals doing better at times. But now we're sort of in a bit of this transition phase where all of a sudden you're seeing stocks like Netflix have a nice rally. Some of the energy names obviously have struggled a little bit. As we go through this period of sort of transition, what are you looking at for opportunistic ideas here? Are there areas of the market where you see present opportunity given sort of this cocktail of confusion, as I might describe it?
Yeah, I think for energy, we're looking at energy as viable, right? They still have those names, the best trends in the market, or among the best trends. I'd say big pharma is also there too. I know you mentioned healthcare before. Now, maybe we just need to be patient here. You look at energy, the chart you have up here, there was a pause late last year and then energy resumed higher. So we still like that space. And then in the more tactical sense, I look at Netflix, I look at Roku, Pinterest, some of these super high beta names, high growth names. Perhaps they're signaling that rates are going to come in a little bit more because of their long duration, characteristics. But I would not overstay your welcome here. They are still trading well below downward sloping 200 moving averages. The trends there in the big picture are ones we want to avoid. But again, if you want to plan for a summer rental, go ahead. Just keep your leash tight there. And then I would move back towards the energy type names, which are still have the benefit of better underlying trends over the last, call it 2 years.
When you're looking forward, I know, you and Chris Verone and others at the team at Strategas do such a great job of thinking about where all these different assets are headed and trying to make sense of them. When you're looking at the major averages, the S&P and the Nasdaq, look forward with us over the next couple of months. Do you see this as a period of elevated volatility, elevated uncertainty? Or are you still more of the overall bear market mindset? Or what are you thinking looking forward here over the next couple of months?
I'd say volatility stays with us. You've had 90% of days this year see a 1% trading range on the S&P. That's up there with 2008 and 2000, right? Super bear markets. Yep. I think it stays with us. I would guess a very choppy market, especially if you get this sector rotation between tech and energy and whatnot. But you're still in a pickle here with equity markets. There's a tighter Fed. We're dealing with the inflation issue. So I struggle to say we're all in the clear yet, and tread carefully, at least out there. Know what you're buying and what your stop losses are.
As always, but especially in this kind of environment, right? Todd, listen, it's great to see you. Really appreciate you taking a few minutes and sharing some insights with us. Stay safe there in the New York area, and we'll talk to you again soon.
Same to you, Dave. Thanks a lot.
That's Todd Sohn. Todd's a technical strategist at Strategas Securities, in New York. I love his take on the different timeframes and thinking about tactical. He talked about a summer rental, right? And I think a lot of times people are so anxious to see the end of a bear market, particularly recently, where bear markets just haven't lasted that long. We haven't had an extended, sort of protracted bear market phase for quite some time. They can take a while and they can be drawn out and painful. I will tell you that from experiencing some other ones in market history. Having said that, we have to pay attention to the evidence. And if you caught that, he mentioned focusing on the evidence, looking at the trend in the moving averages, the slope of the moving averages, looking at trend lines and seeing whether we're able to break those. Until we break those longer term signals, don't make long-term decisions with short-term data. Make long-term decisions with long-term data, short-term decisions with short-term data. Great take there, and a lot of little nuggets of wisdom from Todd Sohn at Strategas. Let's continue on today's show and talk about the bottom line. The bottom line is basically a reference to earnings, talking about the top line and bottom line reporting. A lot of times stocks can move significantly. What we've seen at least this week in earnings, a lot of positive surprises. A lot of number of companies coming in above estimates. Now they're fairly negative estimates, and we're beating the very negative estimates. So I don't know how great I would feel about that overall, but it's certainly indicating an amount of pessimism that may have been invalidated or not as negative as it needed to be. But let's look at the charts and see what the charts are telling us about some of these key names. I did want to start with Nasdaq, ticker NDAQ. So we're not talking about the Nasdaq index. We're talking actually the company, the Nasdaq OMX Group. This is in a group called Investment Services in the financial sector. Other stocks in here are things, well, I'm trying to remember what else is in there. I think this is the group with like S&P Global and Moody's and those. I think they're in that same bucket, but I don't remember where all these names are bucketed. I mentally kind of think of them as all sort of exchanges, index providers, data providers, kind of all one big bucket of supportive services to the financial markets. Talk about trend lines being broken. This is what struck me on the chart of NDAQ, is if you take a trend line from the January high, you connect it to the April high, and you look at where we're at today. By my simple trend line analysis, we just gapped up in a big way above 160. We also gapped above a trend line from the recent highs. That also took us above 160. What had happened was the stock bottomed out around 140, nice move up to 160. And the last month or so has been sort of chopping around, kept bumping up against 160 as resistance. Today, the company actually reported before the open today, a nice gap higher and then followed through to the upside. One of the issues we saw, I think last week, companies beating earnings, gap higher, but closing lower through the course of the trading day. Here, the opposite, gapping higher, but then following through. That's a little more encouraging. So remaining above this trend line would be key. Remaining above 160, which is the lower end of that gap, and that resistance we had before also was support going back here in February. I think that's a key level. A chart like this, not a bad chart, not a bad trade, as long as it remains above 160. I often, when we're talking in this environment, I'm a big fan of keeping stops relatively tight because this is a choppy environment that could move very, very quickly right back to the downside. And I want to be prepared for that and make sure that any short-term gains I would have now don't become short-term losses very quickly if I give them all back on a big down day tomorrow or through the end of this week. So an interesting chart, potential rotation higher from Nasdaq. ABT is Abbott Labs, another company that reports this week, and you're not seeing a lot of upside follow through on healthcare. That's what ABT looks like. Johnson & Johnson reporting yesterday before the open, sort of drifting lower the last couple trading days. So healthcare in general had been one of the areas of real market outperformance year to date. You can see just the fact that Johnson & Johnson is slightly up or up, to some degree, while the market's overall been making new lows every month. That's how you're going to outperform pretty well. But the relative strength is taking quite a turn here as risk assets and more growth areas in the market are starting to rally a little bit, and charts like Johnson & Johnson are starting to pull back. So while not a broken chart yet, right, still holding above the 200-day moving average for now, not a great constructive chart, and certainly not outperforming over the last week or two. Now, after the close yesterday, we had Netflix. We talked about that a little bit on the show yesterday, coming in right after the close. It was gapping higher in the after hours trading. Today, certainly following through, and similar to the chart of Nasdaq, we had this rotation. It's all about, can we hold that previous resistance? I think a chart like Netflix gives you a pretty easy follow as well. 200 is a nice big round number right at the May and June highs. I think that's an important level to watch. This isn't a bad chart as long as we hold that level, right? And making sure that we're able to hold previous resistance as support makes this a pretty compelling chart. So I don't have a problem with taking a bite at a chart like this, given the short-term strength, as long as you have a line at which you would lock in your profits, what I would call a line in the sand. As long as we remain above 200, this isn't a bad chart. We start breaking that, then I have to question whether or not we're back in this consolidation phase, whether this was just a false breakout, et cetera, et cetera. Another interesting one to watch is JB Hunt. Now, this is a trucking company with a nice rally. This one, on the other hand, is rallying into resistance. So the RSI up to 60, sort of fizzling out here, potentially rallying into resistance. You need to see this get above 180 to get above the highs from May and June. And that's why I think this might be an important chart to watch. Trucking companies at times have been pretty decent bets, and particularly at the beginning of the year. I remember talking with Grayson Rose here at StockCharts about JB Hunt, about ODFL was another one. These are sort of in that same sort of group to see if you would see, renewed strength, if you see them bounce higher. ODFL is another one, sort of, making a higher low and potentially here making a new swing high. Kind of an encouraging chart, right? And potentially rotating from distribution phase to accumulation phase. It's all about, can we break above previous resistance and hold it? That's what I'd be looking for there. I have to mention this name you may not be familiar with, called Tesla. It's a small cap name. I'm kidding. Tesla's obviously a name with a lot of focus right here. It's been sideways, right? And similar to the chart in Netflix, sort of in a narrow range-bound period. Then you had earnings yesterday, and you saw the yesterday after the close, and you saw this nice rotation higher today, following to the upside. Similar sort of consolidation phase for Tesla, right? A narrowing of the range, lower highs, higher lows. And the question is, can it break out of the range? And I wouldn't be worried about this chart until it gets out of this range. This pattern has to resolve to the upside or the downside, given what we see. We're seeing in the aftermarket, it's up about 1.7%. Trading around 755, which would put it not too far above the current level, sort of right around there. This might be a chart to watch going into tomorrow's session through the remainder of this week to see if you get a break out of this pattern to the upside. Again, it's all about what we do relative to these key levels. Another group to watch here would be some of the airlines. You have United Airlines after the close today. American Airlines AAPL is before the open tomorrow on Thursday's session. Now, these are interesting charts because they're trading higher, but they're trading into a lot of resistance. These are not great charts when I look at them overall because the trend has been choppy. One of my former analysts at Fidelity, Mark Dibble, used to say a chart like this stock doesn't chart well. It's just not a great example. No clear trends, a lot of choppiness, no clear directional movement. It's hard to make money as a directional bet on a chart when there's no real direction, right? When it's sort of sideways and choppy. UAL, at the end of the day, hasn't really made any ground in the last year and a half, going back to late 2021, right about at the same level. We'll see if earnings are enough of an upside catalyst to move these names further to the upside. But I have a lot of skepticism on the whole travel and tourism trade, given the headwinds to their outperformance potentially through the remainder of this year. Let's wrap the show, shall we? Let's go to that 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I had a great conversation there with Todd Sohn from Strategas. I love his work. They do a great job there focusing on market conditions and just bringing to light some great thematic work. We talked about breadth there. We talked about the 90% update, which I think is really interesting. By my read of breadth, I think one of the key stories is how many stocks are regaining their 50-day moving average. The S&P 500 just in the last couple days has now gotten above its own 50-day moving average. The more and more individual stocks that are able to do that, more and more of a case can be made for a bull market phase. Bull markets happen for the most part when this indicator is above 50%, not when it's below 50%, meaning it's much more likely the market is moving higher when over half of the S&P members are above their 50-day. We're right about there. This is where we stalled out in early June. This is why this might be an important chart to watch through the remainder of this week. Chart number 2 is Apple. One of my contacts on social media posted a chart on this in response to one of the charts that I shared, and I wanted to share this as well. The accumulation distribution indicator is an indicator designed by Mark Chaikin that looks at volume on up and down days, sort of an enhanced version of on-balance volume, which Joe Granville introduced decades and decades ago. Mark Chaikin's work using the accumulation distribution indicator showing Apple making a new 52-week high using volume this week compared to the price itself, which is much below that. That shows you that basically there's more volume on the up days, indicating some increased demand. That might be an important theme to follow going forward. Finally, I'm concerned by how some of these healthcare names have stalled out. Some nice performance on charts like UNH and others in the healthcare sector. We've highlighted them in recent weeks on the show. I'm concerned by the chart of UNH showing some bearish engulfing patterns. This is a candle chart zoomed into the last couple months here. You can see the gap higher, and all of a sudden we have these big down days after an up day, and then a down day where day 2 engulfs the range of the previous days. It's called bearish engulfing patterns. You use the upper end of those patterns as a sort of a natural stop to the short-term bearishness. This is a bearish indication indicating some short-term weakness in the chart of UNH. Might be an important sector to watch with healthcare as well. By the way, that is an inverted hammer there in mid-June with a nice indication of stalled downside sentiment as UNH bounced higher. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. As a reminder, all of our previous episodes, some fantastic interviews from some really knowledgeable experts are at StockChartsTV.com. I want to thank Todd Sohn from Strategas joining us from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.